Futures contracts in derivatives are like locking in hotel rates months before a trip to control price risks and take advantage of opportunities. These contracts are agreements to buy or sell an asset such as stocks, commodities, or currency at a predetermined price on a specific future date. While option contracts in derivatives are tradable securities that grant their owner the right but not the obligation to buy or sell at a predetermined amount of an underlying asset at a specific price on or before a certain date. There are two types of options: call options and put options. Let's understand a call option. Imagine you want to watch a blockbuster movie that releases next month, but you're not sure if you'll be free. You decide to book a ticket in advance by paying a small fee now, or the price of the ticket may increase. This is called an option premium. If you decide to watch the movie, you can buy the ticket at the predefined price, and if you're busy and cannot attend, you simply lose that small fee. On the other hand, the buyer of the put option gives you the right to sell at a higher price in case of a price decline. Both futures and options are standardized, traded on the NSE, and overseen by SEBI, ensuring liquidity, counterparty risk mitigation, transparency, cost efficiency, and easy access. The combination of tradability and regulatory oversight makes futures a robust way to manage financial risks. Did you know that NSE is the world's largest derivatives exchange by number of traded contracts for the 6th consecutive year? Now, here are a few essential terms related to futures and options trading. Lot size. It is the minimum quantity specified for trading, which varies by asset. Contract value. It is the total contract value calculated by multiplying lot size by asset price. Expiry. It is the set date when the contract ends. Both futures and options require a margin deposit both upfront and for the duration of the contract. It is charged as a percentage of the contract value. The initial margin is deposited before the trade, offering leverage for large transactions with small investments. The mark-to-market adjusted daily account balances based on price movements. Meanwhile, the span margin and exposure margin are essential for maintaining positions. If margins fall below the required levels, a margin call demands additional funds. Otherwise, the trades may be squared off by the stockbroker. Most traders enter into a futures or options contract to gain from their directional view on an asset's price. To bring in sustained confidence in clearing and settlement of securities, NSE Clearing Limited provides a robust and well-governed multi-asset CCP infrastructure with global presence for safe and efficient value-added services through robust, strong risk management systems and processes setting global benchmarks. Now, let's take a simplified example of how a futures trade actually works. Say XYZ Limited, a leading IT company, announced cautious guidance, causing its stock to fall by 3.5% to 3,200 rupees. As a trader, I believe this reaction is exaggerated because a slowdown in the IT sector during the season is a known trend. Based on this, I expect the price to move up and decide to buy XYZ futures at 3,210 rupees with a lot size of 100 shares. Here, my contract value would be 3,21,000 rupees, which is 100 times 3,210 rupees. And the initial margin required at 10% is 32,100 rupees. After fulfilling this, I have one lot of XYZ futures expiring in the near future. At this date, if the price goes up to 3,300 rupees, I make a profit of 90 rupees per share. If the price goes down to 3,150 rupees, I would incur a loss of 60 rupees per share. Let's take a simplified example of how a call option works. Imagine you believe the price of XYZ stock, currently trading at 2,200 rupees, will rise in the next month. You buy a call option with a strike price of 2,300 rupees, meaning you have the right to buy the stock at 2,300 rupees even if the market price goes higher. For this right, you pay a small premium, say 50 rupees. If the stock price reaches 2,400 rupees by the expiry date, you can exercise your option, buy the stock at 2,300 rupees and then sell it at the market price of 2,400 rupees, making a profit after deducting the premium paid. If the stock price stays below 2,300 rupees, your option expires worthless and you only lose the premium. Before trading in futures and options, all investors must conduct due diligence such as understanding the product, its performance, and the key terminologies used. Performing due diligence on the underlying asset. Derivatives instruments like futures and options have higher risks and higher leverage. Here, risk refers to the potential for loss due to market changes or counterparty failure, while leverage refers to paying a small amount of money for large exposure, amplifying both potential gains and losses. Checking the lot size, ticket size, expiry dates, and settlement type. Being aware of the obligation to buy or sell in a futures contract, unlike an options contract. Analyzing market trends by performing fundamental analysis to study the financials of the underlying asset or economic indicators. You can also use technical analysis with charts and trend lines. Ensuring you use stop losses and profit targets at predetermined prices. If needed, hedge your position using different strategies and avoiding over-leveraging. By understanding these elements and associated risks, traders can make informed decisions and strategically leverage futures contracts. Make sure you always approach derivatives with diligence. Align your trades with your risk appetite. Here's an overview of key terminologies used in futures and options trading for your reference.
सोच कर समझ कर इन्वेस्ट कर